Right now, half the internet is arguing that artificial intelligence is the most massive financial bubble in history, while the other half insists it is the most important technological leap since the internet. Both sides are staring at the exact same metric to prove their point: user demand. The problem with tracking adoption rates and user growth is that those numbers can lie to you. Demand is inherently noisy, entirely narrative-driven, and most importantly, it can be mathematically manufactured by the companies trying to sell you the story. This is an animated diagram showing the flow of capital between today's biggest tech firms. An investment leaves NVIDIA and funds OpenAI. OpenAI then uses that money to pay Oracle for computing power. Finally, Oracle takes those funds and buys more chips from NVIDIA. The exact same dollars are just running in a circle, and every time the cash passes hands, a company records it on their balance sheet as brand new customer demand. That isolated loop does a fantastic job of inflating revenue and keeping the hardware moving. It creates an illusion of a booming, healthy market, completely masking the actual underlying economics of the tech sector. Because you can fake user growth, serious investors ignore the noise of the demand side. Instead, they track the only metric in the market that requires hard cash committed upfront: the actual supply of capital. This chart visualizes the true scale of the supply side. This year alone, the largest tech companies in the world are on track to spend $725 billion on artificial intelligence infrastructure. To put that in perspective, if you spent $1 million every single day, starting from the birth of the Roman Empire all the way to this exact moment, you still wouldn't hit the amount of money big tech is pouring into AI in a single year. We are seeing a concentration of capital that exceeds the spending of almost any previous build-out in history. When an industry commits capital at this scale, it follows a specific, repeating blueprint, an economic pattern that has dictated the rise and fall of markets for over 200 years. Understanding what happens next doesn't require a deep dive into computer science. It requires looking at the specific mechanics of how capital flows through a new industry, a framework known as the capital cycle theory. This scale illustrates the first phase of the cycle, the flood. Based on ideas laid out by Adam Smith, whenever a new technology promises high returns, money naturally floods into that space. The sheer volume of incoming capital creates intense competition, which eventually drives those returns down for everyone involved. That leads directly into phase 2, the boom. As the money keeps pouring in, competitors build out physical infrastructure far faster than the actual consumer base can expand to use it. In the 1840s, British investors threw an estimated 7% of their entire national economy into railway stocks in a single year. Companies stopped building routes the country actually needed and blindly duplicated lines to tiny villages, prioritizing share price over utility. The exact same dynamic repeated in the late 1990s. Telecommunications companies buried 80 million miles of fiber optic cable across the United States. They laid the wire to cash in on the hype, resulting in 85% of that infrastructure sitting completely unused in the dirt. Today's tech giants are running the exact same playbook. They are trapped in a race to build identical data centers and purchase identical chips, ensuring their massive supply will eventually compress their own future profit margins. When the math finally catches up to the market, we hit phase 3, the collapse. The absolute flood of new infrastructure eventually erodes the profitability of the industry's pioneers, forcing prices to plunge and bankrolling a cycle of failure. By 1850, British railway shares were worth less than half their peak value. More recently, between 2014 and 2016, an oversupply in shale drilling caused oil prices to drop from $100 to $30 a barrel, leading to more than 200 bankruptcies across the North American energy sector. Look closely at the center of the current AI boom, and you'll see the exact same financial fractures appearing inside OpenAI. This chart breaks down OpenAI's recently leaked financials. It shows an $8.5 billion loss for the year, but the real warning sign is further down the ledger. They spent $5.7 billion exclusively on sales and marketing. That means 44% of their entire revenue is being spent just to keep their current user base from moving to a competitor. These falling returns are already impacting the hardware market. When chipmaker Broadcom slightly lowered its forward guidance by a few $100 million, investors erased $300 billion of the company's market value in a single trading session. A market priced for perfection cannot survive routine turbulence. The coming correction won't be triggered by a failure of the technology. It will happen because the sheer volume of supply is destroying the profit margins of the pioneers who built it. This brings us to the final stage of the cycle, the inheritance. This is when the original investors go bankrupt, but the physical infrastructure they paid for remains in the ground. When the telecom companies collapsed in the early 2000s, their shareholders lost fortunes, but those 80 million miles of fiber optic cable didn't disappear. A few years later, a new wave of companies scooped up that bandwidth for pennies, using those discounted assets to build the modern internet. There is a recurring pattern in these cycles. The pioneers get the arrows, and the settlers get the land. The first movers take all the financial hits to prove a market exists, often failing just as the infrastructure they built becomes useful. Alta Vista spent millions developing the first web crawlers, taking the hits so Google could walk in and dominate search. Sidecar spent years fighting municipal taxi commissions in court, clearing the legal path for Uber and Lyft to take over the world. Look at the capital committed by today's tech giants. They're effectively acting as pioneers, bankrolling global infrastructure with their own losses. The eventual consolidation of this market isn't a failure of AI, it's just the final stage of the cycle. While the pioneers burn through their cash, the true victors are likely waiting for the dust to settle, ready to inherit a global infrastructure for pennies on the dollar.
If this pattern of manufactured hype hiding real financial cracks can fool investors in AI, imagine what else it's hiding. Right now, the exact same playbook is running in two other trillion-dollar markets, cryptocurrency and the global oil trade. And once you see the data, you won't be able to unsee it.
Right now, two competing stories are dominating the global economy: the promise that cryptocurrency will replace the traditional banking system, and the fear that a conflict in the Middle East will crush global trade. Trillions of dollars, corporate strategies, and national policies are being deployed based on these exact assumptions. But when you test these widely accepted ideas against raw structural data, the underlying logic collapses. Beneath the marketing hype, Bitcoin operates as a fragile mechanism that requires a constant stream of new participants to sustain its value. Meanwhile, the panic over the next energy crisis is hiding a structural shift that provides one side with massive asymmetric leverage. To see who actually holds the power in modern finance, we have to look past the headlines and follow the structural data. When Satoshi Nakamoto published the original Bitcoin white paper in 2008, the stated goal was clear. It was supposed to be a peer-to-peer electronic cash system, a decentralized way to bypass the traditional banking sector entirely. This chart compares transaction speeds to test the first strict rule of money: it must function efficiently as a medium of exchange. While the Visa network clears roughly 65,000 transactions every single second, the entire Bitcoin network processes barely 500,000 transactions in a full day. That inefficiency compounds when we look at the physical infrastructure. Clearing a single Bitcoin transaction drains roughly the same amount of electricity as an average American household uses over 43 days. The second economic rule is that money must be a reliable store of value. Assets that swing 20% in a single month are treated by households and businesses as speculative bets, which makes them unusable as stable financial reserves. This is a distribution graph showing network ownership, and it challenges the core promise of decentralization. Roughly 2% of addresses control 95% of the total supply. That top-heavy concentration leaves the market highly exposed to price manipulation by a small group of large holders. We already ran a real-world stress test on these theories. In 2021, El Salvador adopted Bitcoin as legal tender under President Nayib Bukele, requiring businesses to accept it and heavily promoting a national digital wallet called Chivo. This data visualization illustrates international remittance utilization, which was supposed to be Bitcoin's ideal use case. Despite the government mandates and a $30 sign-up bonus, IMF data shows that less than 2% of the country's remittances actually flowed through the system. The behavioral data highlights the rejection even further. 60% of users downloaded the national app solely to cash out the free $30 incentive, and then immediately abandon the platform. Because it fails these functional tests, the current price is dependent on the greater full theory. The ecosystem relies on a continuous stream of new buyers entering the market to purchase the asset at a higher price later. This map isolates the Strait of Hormuz. Historically, the global understanding was that because 20% of the world's oil flows through this narrow channel, any disruption here would automatically paralyze the United States economy. But new drilling and shale extraction methods over the last 20 years changed America's reliance on foreign imports. This timeline chart tracking global production output shows exactly when the United States surpassed its rivals to become the largest oil producer on the planet. Expanding that dataset to include liquefied natural gas, or LNG, reveals a similar trend. Over the past decade, the United States has also become the world's largest LNG exporter. So the vast majority of Middle Eastern crude isn't heading west anymore. Roughly 75% of it flows directly toward Asian manufacturing hubs like China, India, Japan, and South Korea. This creates an asymmetric economic shock. If supply tightens globally, the US experiences a manageable price inflation that generates revenue for its domestic energy companies. But for China, losing access to physical energy inputs can trigger a mechanical shutdown of factory floors. China has attempted to stockpile reserves and diversify its partners, but as the world's largest oil importer, consuming around 16 million barrels a day, they remain exposed to their structural reliance on these shipping lanes. A bottleneck in the Middle East is no longer a shared global crisis. It selectively punishes America's primary manufacturing rival while enriching US energy producers. Whether it's the marketing promises pushing digital currency or the outdated panic surrounding energy trade, these stories often mask who is actually trapped by the data. Tensions around global energy choke points reveal a deep structural imbalance that impacts the trade and technology negotiations between the world's two largest superpowers. True leverage is generated when one nation can comfortably tolerate an economic shock that fractures the structural integrity of an opponent. So the next time you see headlines about a financial asset or a looming global shortage, ignore the marketing, strip away the narrative, trace the raw data, and ask one simple question: who relies on the story, and who is quietly holding the leverage?